Hello everyone and welcome to today's video. In today's video, I will be discussing 5 different types of business structures when you are expanding or starting a business. The 5 business structures that I'll be looking at is sole proprietors, partnerships, private companies, public companies, and a trust. A sole proprietor is when you trade in your own name. This can be as easy as opening up a separate bank account, issuing invoices to clients, and deducting expenses from your income. The advantages of trading as a sole proprietor is that it is easy to set up and maintain. You are able to maintain 100% control over the income, the assets, the liabilities, and the expenses of your business. You are entitled to all the profits of your business. So if you have a profitable business and you're making some money, you are entitled to all of those profits. You are also in control of the business and you are able to make all the decisions and guide the business in the direction that you want to. What are the disadvantages? So the owner assumes all the risks for the business and the owner's assets can be seized to pay any business debt. So say you're running a business and you run into debt, then any authority or creditor may come after your personal assets. So that can be dangerous. And also, if you want to include another business owner as a sole proprietor, you will have to form a new business. The next business structure is a partnership. So a partnership is when you and a few partners come together, you form a partnership and you trade as such. What are the advantages? So if you have more people, that means you will have more knowledge and more expertise. You will also have more capital and more cash to work with as there are more contributors. You're also able to share the financial burden and the expenses of running a business with partners. So a partnership is where two or more people come together. They start with a partnership agreement. So they will say, I will contribute so much cash or I will contribute my skills, and they start running a business together. There's also even distribution of labor because there's multiple people working on the same business, and you are able to maintain a better work-life balance if you have more people working on the business. So what are the disadvantages? Everyone is liable for the debts, and sometimes debts can be caused by the other partners, which you will then also be liable for. You also have to share control of your business with the other partners, and you may have fallouts or arguments with your partners that may put some strain on your business. A partnership may be difficult to sell if the other partners do not want to sell at the same time, and if one of the partners wants out, then the partnership will most likely have to dissolve and a possible new partnership will have to be formed. The next one is private companies that have private shareholders. So, what are the advantages? You have privacy on your finances and decisions. What this means is that you don't have to share your annual financial statements or you don't have to explain any decisions that you make to the outside public. A private company is also a separate legal entity, which means that it's separate from you in your personal name. You can sell your shares or you can take on new shareholders in a private company, and the shareholders will not be liable for the debt. Usually, when you set up a private company, you will appoint directors to manage the company. If any of those directors act fraudulently or recklessly, they may be held personally liable for the debts of the private company. Now, what are the disadvantages? So, there's a number of legal requirements that you have to comply with. In South Africa, we have the Companies Act that guide how companies should be regulated. So you'll have to meet the Companies Act requirements. You'll have to register with the CIPC, and you'll also have to submit returns to SARS. It can be challenging and expensive to register a private company, and you can't offer your shares to the public or sell them on a stock exchange. When you want to make decisions in a private company and there are more than one director or more than one person making the decisions, it can be harder to pass a decision. In private companies, you may have to draw up financial statements or have an independent review done by an independent reviewer, or have your books or your annual financial statements audited by auditors. This will depend on your public interest score. I'm not going to discuss the public interest score matrix in this um, video. The next one is public companies or public shareholders. So, a public company will be able to offer their shares to the public, which means that they will have more capital to work with. You can also list your public company on a listed stock exchange where fund managers can be appointed and traders can keep an eye on your business. What this means is that more people will be able to see you and more people will be able to invest in your business, and you will have exposure to greater business opportunities. When there are more shareholders, that also means that there's less risk for each of the shareholders. So if you have 100 shareholders versus one shareholder, that means that the risk will be spread over 100 shareholders. What are the disadvantages of public companies? It may be more challenging to set up compared to a sole proprietor or a partnership. It's also, you have to comply with the Companies Act. It may be more but difficult to make decisions as there will be more shareholders, more directors, and more management involved in the decision making process. You also have to reveal some of your documents and your annual accounts to the public, so the public can request your annual financial statements, they can request your tax returns, and this may make it difficult to guard some of your trade secrets effectively. So, say you come up with a great idea, you want to make some money off it. If you register a private company, just take care because you may have to disclose some of those secrets to the public of how you do it. Also, selling ownership of your company to strangers. So, when you set up a private company, you will go to the public and you'll try and get funding. It may be difficult to get funding and not give away managing or the majority shareholding of your company. You'll ideally want to keep at least 51% so that you'll be able to make the decisions and still have some control over your company. The next one we'll be looking at is a trust. So, how a trust works is that a founder will have assets that he will donate or give to a trust on a loan account. These assets, which is referred to as the trust property, will then be managed by the trustees. So, this will be a family member, an accountant, a lawyer, and this will be managed for the benefit of beneficiaries. So, this may be a wife, some kids, or anyone that will need financial assistance. So, what are the benefits of or the advantages of registering a trust? The growth of an asset in a trust will not be subject to estate duty. So what that means is if I transfer a asset, for instance, a property to a trust at a value of 100 Rand, and that asset or that property increases in value to 200 Rand, that means that the growth for capital gains tax and other taxes will be for the account of the trust and will be outside my personal income tax or estate duty. A trust does not die when I die, so when I die, the trustees can keep on managing my assets and providing income to the beneficiaries as is needed. The assets and benefits in a trust will continue to be paid when I die, and you will also have the protection of assets whereby the beneficiaries can't come and lay claim on the assets inside a trust. Also, another advantage is that the income from a trust can be constructed in a tax efficient way by splitting the income. So, say you receive trust income, for example, rental income, and you have five beneficiaries, you may be able to split that 100 Rand, 20 Rand to each of the five beneficiaries and have it taxed at their marginal rate. There is some credit protection in a trust when a beneficiary is insolvent. So if a beneficiary can't pay their debt, then they can't lay hold of the trust assets. There's also disadvantages of registering a trust. You won't have full control as the other trustees will also have a say. The trust needs to be registered with the relevant authorities, which may gain access to it. So, a trust is registered with the Master of the High Court. The Master of the High Court may request your annual financial statements and as well as your minutes or your resolutions of the trustees. If there is an issue with the trustees, this may affect the successful management of the trust. Also, setting up and maintaining a trust may be costly. So you have to put a trust deed in place. You have to submit taxes. You may have to compile annual financial statements. So all of that will add to the maintaining cost. It is also more difficult to make decisions as trustees as you have to vote on decisions. So the more people there is that have to make a decision, the longer the decision making process um, can take. A trust is required to comply with the Trust Property Control Act in South Africa that governs how trust should be run, what documents should be kept, what the trustees should be doing and shouldn't be doing. And you are also required to submit annual and provisional tax returns to SARS. If you would like more information or you would like to request the slideshow, you're welcome to send me a mail at my email address on the screen right now. And I want to thank you very much for taking the time to watch this presentation. I do trust that you find this presentation useful, and if you like it, please feel free to subscribe to my YouTube channel. Please feel free to send this video around, and you can also check me out on LinkedIn on the link provided. I thank you for your time. Goodbye.